Good day, ma'am. Good day, everyone. Today, we are going to present to you our matrix with regards to the topic leases. And I am Jasper Nacua, and here with our members, April Joy CALARIAN, DANIZA, TAMAYO, and Grace H. PABLIO. Without further ado, let us now start with the finance lease, lessee, or the lessee accounting. Definition of terms: lease is a contract that conveys the right to use an underlying asset for a period of time in exchange for consideration. Whereas the lessee obtains the right, the lessor provides the right. Underlying asset is the subject of the lease, and the lease term is a non-cancelable period. For the accounting treatment, generally, all leases shall be accounted for by the lessee as finance lease, in which the lessee must recognize the right of use asset and lease liability. But the lessee is permitted to have the operating lease through an accounting policy election. For initial measurement, the right of use asset is initially measured at cost. Inclusions of cost include PV of lease payments made to the lessor, initial direct costs, and estimated cost dismantling, removing, and restoring the underlying asset. For subsequent measurement of RUA, it is subsequently measured as using cost model, in which RUA is equal to the cost less any accumulated depreciation and impairment loss. Other measurement models are fair value model and revaluation model. For depreciation of RUA, the RUA is depreciated using the useful life of the asset if the lease transfers ownership and reasonably certain that to exercise a purchase option. If the conditions above are not met, then normally lease term is used. For measurement of lease liability, we have the PV of lease payments. It is discounted using the interest rate implicit in the lease. Components of lease payments include fixed lease payments, variable payments, exercise price of purchase option, guaranteed receivable value, and termination penalties. For actual purchase of the underlying asset, we have right of use asset less accumulated depreciation, add cash payment less lease liability is equal to the cost of equipment purchased. I also attached here things to remember in computations for convenience in computing present values, interest, and depreciation. For other accounting issues, we have extension option. Extension option, this is an option of the lessee to extend the lease for further years. Exercise of extension option leads to remeasurement of lease liability. So here are the remeasurement formula stated in the matrix for extension option. For variable payments, this is another accounting issue in which payments are not uniform. For lease modification, IFRS 16 provides that the lessee shall account for the lease modification as a separate lease under the following conditions. The modification increases the scope of the lease by adding the right to use an underlying asset, and the rental for the lease modification increases by an amount commensurate with the increase in scope and equivalent to the current market rental.
Good morning. My name is April Joy F. CALARIAN, and I will be discussing to you operating lease lesson. By definition, finance and operating lease differ in transfer of ownership. Finance lease transfer all the risks and rewards, while operating lease does not. In classifying finance and operating lease, it does not depend on the contract alone, but rather on the substance of transaction. We have major criteria and determinative in nature. We have first, the transfer of title, a lease transfer of title to the lessee at the end of the term. Second, purchase option. So the lessee has the option to purchase the asset at efficiently lower than the fair value. We have third, lease term. This is a major part of the economic life, which means 75% of the economic life of an asset. Fourth, we have present value of lease payment. This is substantially all the fair value, at least 90% of the fair value of the leased asset. We also have suggestive in nature, which is the other criteria under paragraph 63 to 64, which states that first, only the lessee can use it without major modification. Second, we have the lessee can cancel the lease, then the lessor's losses will be associated borne by the lessee. We have third, gain and losses from the fluctuation in fair value of the residual accrued to the lessee. We have fourth, the lessee can continue the lease for secondary periods substantially lower than the market rent. Operating leased income shall be recognized as either a straight line basis or another systematic basis. We have first, rental. So the periodic rental received by the lessor shall be recognized as rent income. Second, depreciation. So the lessor's normal depreciation will be also recognized. And then we have the third, initial direct costs. Operating lease shall be added to the carrying amount and recognized as expense. We have fourth, security deposit, which is refundable and liability by the lessor. We have fifth, lease bonus, which is recognized as unearned rent income. We also have a special case of unequal rental payments. This means that operating lease requires unequal cash payments. It will be amortized uniformly on a straight line basis. Thank you.
Good day, I am Grace H. PABLIO. So let's move on to direct financing lease lessor. Definition. Under a direct financing lease, a lessor acquires assets and lesses them with the intention of generating income through interest. The lessor is neither the manufacturer nor a dealer of the asset. Accounting consideration. Gross investment, net investment in the lease, unearned interest income. Initial direct cost. Measurement. Lessor recognizes interest income over the lease term. Initial direct costs are included automatically in the net investment. Lessor account for both guaranteed and guaranteed residual values, provided that lease asset reverts back to the lessor at the end of the lease term. If the lease asset does not revert back to the lessor does not account for any residual value. Recognition. Fair value of at the end of lease term lower than residual value. Guaranteed. The lessee will pay for the difference. Journal entry of the lessor, debit to cash, debit to lease asset, credit to lease receivable, and guaranteed. The lessor shall recognize a loss for the difference. Journal entry of the lessor, debit to loss on finance lease, debit to lease asset, credit to lease receivable. Concept. Net investment is equal to PB of lease payments, which includes any guaranteed residual value plus PB of unguaranteed residual value equals fair value of underlying asset plus initial direct cost. Thank you.
So I'm Daniza as Tamayo, and now we're on sales type lease under the point of view of the lessor. So as we start, we'll consider this vital question: who is the lessor? So it's important to be known since finance lease accounting is dependent upon who the lessor is. So when we say sales type lease, we got indicators, and the lessor and the owner of the asset you're buying for are the same, which calls for the recognition of profit and loss in the point of view of the lessor. So in the initial date first, we're debiting a lease receivable for what basic reason? An asset was owed, therefore the dealer or the lessor will definitely record the receivable. And since we're on a sales type lease, what is to be credited is sales because the lessor is a seller at the same time. We're also going to credit an earned interest income because in sales type, aside from gross profit, another motivating factor is the interest, and it has to be recognized over the lease terms. And since enough time has not yet passed for it to be recognized as earned, we record it as an earned interest income. So now in sales type lease, there is an inventory system involved. So if perpetual inventory system is used whenever there's a sale, there's a subsequent entry debiting cost of sales and crediting inventory. So let's proceed for further accounting treatments, and we'll go to gross investment. So when we say gross investment, this is how much the lessor is going to receive in absolute amount during the lease term, and that includes rental payment coming from the lessee and the residual value guaranteed if it's from the lessee or unguaranteed if it's from the party related to the lessor. So additional info about residual value is that it is accounted when the leased asset reverts back to the lessor at the end of the lease term. However, when it doesn't, the lessor does not account for any residual value at all. So next is a net investment in the lease, which is the present value of the lease payment and the residual value or the fair value of the asset. So why are gross and net investment that remain? That's in order for the earned interest to be known. So also for the initial direct cost, the treatment is that they're expensed immediately as part of the cost of sales. So for the accounting treatments, we're specifically laid down the matrix and going down the disclosure in a particular sense. A lessor shall disclose its risk management strategy for the rights it retains in underlying asset, including enemies for which the lessor reduces the risk. So also attach the matrix to the performance entries and means of computations for these type of lease. So that's all for sales lease type. Thank you so much.
And now we are now down for our last topic of the leases, which is the sale and leaseback. Sale leaseback, it is an arrangement whereby one party sells an asset to another party and then immediately leases the asset back from the new owner, wherein the seller becomes the seller lessee and the buyer becomes the buyer lessor. Take note that there is no physical transfer of an asset. There are two distinct transactions are recognized. There is a sale first, and second, there is a lease agreement for the same asset in which the seller is the lessee and the buyer is the lessor. For the accounting treatment, we have the operating lease. We have the books of seller lessee to record the following: proceeds from the sale, the recognition of asset, gain on sale, and the rent expense. For the books of the buyer lessor, they're going to record the following: the asset acquired, rent income, and depreciation of asset. For finance lease, the seller lessee shall apply the finance lease model, while the buyer lessor shall account for the purchase of the asset applying the lessor accounting standard. For the finance lease, we have the measurement of lease liability. So the lease liability is measured at the present value of lease payments. For the right of use asset, the seller lessee shall measure the right of use asset arising from the lease back at the proportion of the previous carrying amount of the asset that relates to the right of use retained by the seller lessee, in which RUA is equal to the PV of lease liability divided by the fair value of the asset times the carrying amount of the asset. We have the gain or loss to be recognized. The gain or loss that pertains to the right retained by the seller lessee is not recognized. Only the gain or loss that pertains to the right transferred to the buyer lessor is recognized. And here are the formulas for the total gain, right transferred to the buyer or lessor, gain to be recognized, and gain not to be recognized. For sale price above fair value, any excess sale price over the fair value shall be accounted for as additional financing provided by the buyer lessor. The seller lessee shall make adjustments to measure the sale price at fair value. The PV of lease liability related to rentals is then sold. We have second, the sale price below fair value. If the sale price is below their fair value, the difference is accounted for as a prepayment of rental. And lastly, the transfer of asset is not a sale. According to IFRS 16, it provides that if the transfer of an asset by the seller lessee does not satisfy the requirements for the recognition of sale, the seller lessee shall continue to recognize the transferred asset and shall recognize a financial liability equal to the transfer proceeds. And the buyer lessor shall not recognize the transferred asset but shall recognize a financial asset equal to the transfer proceeds. Thank you.